Hello and welcome to In Conversation with DLC's Chief Economist, Dr. Sherry Cooper. Today's edition is brought to you by FCT. I'm your host, Eddy Cocciollo, President of DLC. I'm coming to you from La Belle Provence in the city of Montreal. Bonjour, mes amis. I firstly want to apologize for being approximately 20 minutes late. I was having some issues being in a hotel room in a new city, but we got it all sorted out and we have a great show ahead for you. So, Dominion Lending Centers is made up of over 4,000 mortgage professionals right across the country with access to Canada's best mortgage rates. Whether you're buying your first home, refinancing, self-employed, moving on up or downsizing, with access to hundreds of financing options, we can find the right fit for you. If you're not using a DLC mortgage expert for your home financing needs, you're probably paying too much. Visit DominionLending.ca today and find a mortgage expert near you. Allow us to be your trusted advisor when it comes to managing your debt. Dr. Sherry Cooper is celebrating her 7th year with Dominion Lending Centers. She is a sought-after speaker, writer, advisor, renowned for her ability to simplify and demystify the complex subjects of economics and financing. Sherry helps Canadians understand the issues surrounding their most important financial decisions, buying a home. Also, on DominionLending.ca, click on Economics Insights for Sherry's very insightful articles and the latest economic trends. Oh boy, Sherry, I mean, you must be really, really busy. There is so much going on. We anticipated a half a point raise. It happened. And if you're reading the Bank of Canada and Tiff Macklem's words, it's not very comforting, is it?
No, definitely not. In fact, I mean, they couldn't have been more hawkish. I've never seen a press release like this one, and that he's pretty much telling us that he knows he's behind the curve. He knows he's going to have to hike rates, and in fact, he may have to hike rates more forcefully than he's already done. So I think that says they leave open the possibility of a 75 basis point rate hike at the next meeting on July 13th.
Yeah, and I really thought it was interesting that he keeps repeating that their mandate is a 2% inflation. Like there's no adjusting to that. You would think that maybe he'll go to 3% or say, hey, you know what, we just want to get to 4%. But no, he's sticking to his mandate, and that kind of worries me a little bit, only because to get there, it may take a lot of rate rising. What are your thoughts on that?
Well, for a while when they were talking about transitory inflation, remember they were satisfied with inflation moving above 3% temporarily and not a big deal. But that is now it's a very different situation. They have underestimated inflation, and I have a chart that will show that many, many, many times. And now they are suggesting that inflation is going to rise further before it begins to fall. So clearly they are of a mind that they've got to take the overnight rate up to between 2 and 3%. Right. And maybe even higher. And right now they're only at 1.5, even with the 3 rate hikes this year.
Okay, let's get started. Just a reminder, if you have any questions or comments, please type them in and I'll get to them as soon as I can. Again, I want to thank FCT for sponsoring us today. And let's go through these slides. This should be exciting.
Thank you. So to begin, I wanted to quote something or show you something that Mark Carney has just said, and this is like in the past few days, that the long era of low inflation, suppressed volatility, and easy financial conditions is ending. The former governor of the Bank of England, and before that, the Bank of Canada. The economics of the coming period will be more challenging, he said. So, non-transitory inflation is mounting. We're seeing deglobalization. That's because of all of the global disruption. Untapped supply of cheap labor is slowing. Net zero, the actions taken to deal with climate change, is very costly. That's another factor pushing up inflation. A housing shortage in many parts of the world, but especially in Canada, is keeping pressure on rents. And then a possible offset is productivity growth. But Canada's been struggling with its productivity growth for a very long time. So getting into the details of all of this, of course, we see globalization stalling, because what we have instead is, thanks to initially the pandemic and the disruption in supply chains, we're also now experiencing this war in Ukraine that's moving into its fourth month. And trade is falling, prices are surging, businesses are stockpiling, and economic activity in some parts of the world, particularly in Europe, has slowed considerably. So everywhere in the world, there's an attempt to shorten the supply chains and bring more business manufacturing onto domestic shores. And jobs have become even more urgent. And of course, we have enormous job vacancies in Canada as well as in the United States. So what does all of that mean? It means that we have little choice but to continue to be concerned about inflation. And as a direct result of that, we know that the central banks around the world are continuing to tighten monetary policy. We've also seen businesses are seeing that these kinds of disruptions reverse the lean inventory model. Remember, it used to be just-in-time inventories, but now businesses are stockpiling goods 6 months ahead, and warehouse space is in very short supply. Moreover, as I've shown this chart before, the Ukrainian war is leading to a slowdown in global economic activity, as well as a big increase in inflation. So compound that, we've got Canada actually outperforming the rest of the world, because Canada has a commodity-rich economy and it's straining at its limits. The one reason that growth is so much stronger in Canada than in the rest of the world in general, particularly the G7, the developed world, is because we have such a large energy sector and energy prices have increased sharply. So Canada's economy continues to expand on consumption strength. We saw 3.1% growth in Canada in the first quarter. That was released yesterday. That number would have been considerably stronger had it not been for a reduction in trade flows. And that's very much the result of all this disruption. But Canada, you see, is likely to grow in excess of 4% this year. That's above the growth in the rest of the G7. So US growth is probably more like 2.5%. And this is a chart that I think is really interesting. You can see the growth in Alberta is dominating the growth in the rest of Canada at 5.6%. And that's well above other commodity-rich countries like Australia, and considerably higher, of course, than much of Europe and Japan. So I guess that's the good news for our economy, is that it is so strong. Higher inflation and higher interest rates have certainly dampened Canadian consumer sentiment. This shows you Canadian consumers are concerned about the weakening in housing and what that may bode for the future of the economy. In addition, I'm showing you here that that the job market in Canada is very, very tight, with considerable labor shortages. Employment growth slowed in April, but it's well above the pre-pandemic level, further above than in the United States, and certainly much further above pre-pandemic levels than in Europe. And the jobless rate is at a record low. So well below the 5.7% before the pandemic began. We see the unemployment rate in Canada at 5.2%. Very tight labor markets. Canadian businesses are citing that labor shortages is a primary growth constraint. So we've got job vacancies have moved up again to 1 million job openings going unfilled. So that's what the Bank of Canada is referring to when they talk about continued excess demand in Canada. As a result, Ottawa has eased temporary foreign workers program to reduce labor shortages. And as well, you know that wage rates are rising. Inflation is still outstripping the 3.3% year-over-year gain in wage rates we saw posted in April, given that the March inflation numbers were at 6.7%. They subsequently moved up to 6.8%. And wage inflation is likely to accelerate further. We see that average offered hourly wages in the hotel and restaurant industry has surged in recent months. So that's one of the sectors, along with retail, that sees continued large numbers of vacancies. So all of this is pushing up inflation. We know that the oil prices, metals, lumber, wheat, corn, and fertilizer prices soared with the Ukrainian war, and those prices continue to rise. And as well, the supply disruptions are also continuing with fuel shortages, food shortages, chips shortages. In fact, we saw the President of the United States, Joe Biden, made a trip to Korea and Japan recently in an effort to bring home some of the production of semiconductor chips back to the United States so we could get more cars, new cars in the US dealers and the Canadian dealers and so many other places where chips are used. So this is seriously a big global problem, not just a Canadian problem. Businesses are paying more to ship goods and to store them in warehouses. And there is record low vacancy rates in warehouses across Canada. So you see the vacancy rate less than 1% in warehouses in Vancouver. Toronto, it's just above 1%, still at record lows. In addition, leasing costs for industrial real estate, meaning warehouse space, have increased 40% in Vancouver and Toronto in the past 3 years. So another big factor contributing to the overall rise in prices. And as I said, March inflation has moved up to 6.7%. April inflation moved up to 6.8%, way above target. Target for the Bank of Canada being 2%. And look at the US inflation. It's now running at 8.3%. In addition, it's expected in Canada that inflation will rise further when we see the May numbers because fuel prices actually decreased over the month of April, but have increased sharply in the month of May. And these domestic inflation pressures are feeding into inflation expectations, which feed into higher wages and higher home prices and rents. So the record 70% of firms see inflation above 3% over the next 2 years. And Eddy, as you mentioned earlier, the bank's actual target is 2%. So that says a lot about what's going to continue to happen to interest rates.
Well, Sherry, so just before we get to the next slide, we have a few questions here. I want to get to them because I think they're important to get at this stage here. I'm gonna ask this first question about forecasting overnight rate. We are already at 0.25 under the pre-pandemic levels, going to reach neutral zone? Question mark. Going to go beyond neutral zone? What do you expect from your experience, Sherry? So do you think it's going to go beyond? I know there's a race to go to the neutral zone. They've been talking about, but do you think it's going to go beyond?
Why, Eddy? It's 2 to 3%. We're at 1.5% right now. So we're still below the pre-pandemic level, which was 1.75%, which makes you wonder why they didn't raise 75 basis points today. But they never commented that they were going to. And the bank, this Bank of Canada under Tiff Macklin likes to tell the market what he's going to do before he does it. So my guess, that's why I'm guessing that unless inflation surprises on the low side, we're going to see 75 basis point rate hike next meeting, which is on July 13th. Now, where are we going from there? That anticipates my next couple of slides. So let me just show you that. Today, we saw another jumbo rate hike, 50 basis points today, with them telegraphing more to come and maybe even more aggressive increases. And we also saw the continuation of drawing down the Bank of Canada's holdings of Government of Canada bonds, which in and of itself also puts upward pressure on long-term interest rates. Now, this is what I was suggesting earlier. This shows you the Bank of Canada's forecast for inflation in all those colored lines, beginning way back in the earliest period, the forecast last July, then the October 2021 forecast, the January and April forecast, and the black line is what we've actually seen. And at 6.8%, it's well above what the bank expected inflation to be right now. So that means they're behind the curve. Now, this shows you what they did today. This is the Bank of Canada's overnight rate. Now, when you think about this, look at what yes, these are the most aggressive tightenings we've ever seen by the central bank, but it is only offsetting the most aggressive easing. So when you think back to the early part of 2020, the overnight rate was at 1.75%, and they took it down rapidly to 25 basis points, which they considered to be the equivalent of zero. So they called it the effective lower bound. So of course they're raising rates quickly. And in some respects, I don't know why they haven't gone all the way to 1.75% today, except that they wanted to tell everyone in advance they were going to do that. So what does this mean? Well, the prime rate before the rate hike today was at 3.2%. And as we speak, it's going to 3.7%, because reflecting that 50 basis point increase. Now, if the bank takes the overnight rate to what they consider to be the neutral zone, which is the non-inflationary zone, it will be between 2 and 3%, which means the prime rate is heading for 4.2 to 5.2%, which will be reflected, of course, in variable rate mortgage loans. Now, nobody really knows what the neutral overnight rate is. And what they need to do is to tighten the monetary policy, meaning to slow the economy. Because without that, there will still be excess demand. Now, we've seen housing slow as a result of the actions they've already taken. But the question that was raised was how far are they going to need to go to break the back of inflation? And if history is any guide, they will need to tighten above expectation. However, housing is a much bigger part of the overall economy than it was back in the early 80s, the last time we saw inflation booming and the Bank of Canada required to break the back of inflation. So in other words, today's economy is much more interest sensitive than it was in the past, and the Canadian economy is the most interest sensitive in all of the industrial world because we have such high household debt and so much of it is at a variable rate. In other words, Americans mostly have 30-year fixed rate loans. And so they're not going to be as interest sensitive in slowing the economy as Canada will be. So it may well be the Canadian economy slows very aggressively in taking the overnight rate up to 2 or 3%. That's the big question. And no one really knows the answer to that question. So, and I wanted to show you the 5-year bond yield. That's the rate that most affects the fixed mortgage rate. You see that it spiked today, but it's been pretty muted in the last couple of months, at least since the middle of April. So again, that's another factor. And the big question is, will the Bank of Canada get the soft landing it's hoping for? Meaning the Bank of Canada would like to slow the economy without knocking it into a big recession. And that's possible, but it's anybody's guess because the slowdown doesn't have to mean a recession, but we've got a great deal of economic uncertainty ahead. So now I'm going to talk about the specifics of the housing market. But Eddy, I'll give you a chance to weigh in here if there are any other questions you want me to answer before we get to that.
There is such good information, Sherry, and lots going on. Yeah, you really know your stuff. Let's ask a couple of questions, then we'll get back to the slides, and then we'll talk about a little more around interest rates and what your predictions are. So the first one is, what do you think? 75 basis points for sure? What's the over-under on that?
Nothing's ever for sure. I just showed, tons of uncertainty. But if inflation doesn't slow in the next reading, which will be it's usually in the second or third week of May. No, I'm sorry, of June. And we won't see by the July 13th meeting, we won't have the June data yet. So it's going to be all about the May number, and it could well be above 6.8%. So if it is, I think there's a good chance, barring a big surprise on economic activity. And housing is always the most interest sensitive. We've already seen housing slow. If you listen to what the realtors are saying, many of them, particularly in the GTA, are talking about, practically like housing activity falling off a cliff. Now, it's particularly in the suburbs, but I think basically we've got potential buyers waiting to see if prices are going to fall. The ones that have a locked-in mortgage rate promise, there are still some that will have had mortgage rates that were promised in January or February. And they are very aggressive buyers. I mean, they are definitely going to go for it. How much we're going to see in terms of slowdown, I think, would largely be in the investor sector, because at today's mortgage rates, the negative carry is quite significant.
So you're talking about the rate holds and the pre-approvals that are lingering 120 days. Those those rates are still around the 2% mark, and they will be buyers, and they don't have much time, so that's going to happen pretty quickly. And then after that is going to be interesting. So let's go to the next question. Harry Howard asked about the psyche of the messaging from Bank of Canada. Is there something there? When they have those messages, are they trying to get to the consumer and saying, hey, let's slow this thing down, or is it just reality?
It's both. I mean, for sure, they're jawboning, and it's very effective to do that, because the hope is that it means that rates won't have to rise as much if sentiment changes. But in the first quarter data we saw yesterday, we saw that consumer spending was still very substantial. Now, that was the quarter ending March 31st, so everything has changed since then. But business investment was also very strong then. And businesses are stockpiling. Inventories are rising rapidly because everybody got caught off guard with no inventory, and now they're doing their damnedest to make sure that they don't miss a lot of sales in the future. But you only have to try to buy something in any area in North America, and you find out that the goods on the shelves are just not up to what would be considered a normal situation, be it from cars to furniture to even clothing. Not to mention, I mean, I have a wedding I'm going to. My niece's wedding is in September, and I can't buy a dress. Believe it or not, this is the largest wedding season in the history of mankind. And anywhere in Canada or the United States, you are having to make appointments to go look at dresses and pay for just the appointment, and nothing is available. It's ridiculous, but that's just one little example.
Yeah, we just have to do a retro wedding theme for all these weddings, and you have to wear something you wore 20 years ago. We solved that problem.
Right.
The next question is interesting from Mortgage Mark. Why not rip the Band-Aid? Just go right for the what we need and end this thing instead of kill us slowly. What are your thoughts on that?
That's what I was thinking. That's what I was thinking today. Why not at least go immediately? Today, why not do 75 so we're back to where we were before pandemic? We know we need to get there. I'm not quite sure, except both the Fed and the Bank of Canada did make comments to suggest that they wouldn't go more than 50 basis points a few weeks ago. But that clearly with the Bank of Canada, that's all out the window now, because they actually said in their statement, the press release today, that they will tighten more forcefully. That was their word. If inflation rises from here.
Makes sense. Okay, let's get to these two quick questions from Jason Nugent, one of your biggest fans, Sherry. Will we see more desire for our oil going forward on a global scale? Is that what we're looking at? Maybe we're going to be able to export more of our oil, or is that just a...
Well, we could if we could. And what I mean by that is, we have to produce more, and many oil companies are not allowed to do that because of the climate change restrictions. And B, even if we produce more, we have to be able to get it to those countries. And those countries are not the United States, but Europe and China and Japan. And we don't have the ability, we don't have the pipeline capacity to get them to our coasts and then onto these large freight steamers that go across the world. And so that's been the big problem for a long, long time.
Yeah, it makes sense. Let's get into the housing slides, and then there's lots more questions. I knew this would be a popular one, but we'll get to all your questions. Give us a few more minutes here. Sherry, let's get to those slides.
So what I show you here is the top 10 cities with the least affordable housing. And unfortunately, Canada has the unenviable situation that our two largest cities are in the top 10 least affordable cities. Vancouver is number 3 and Toronto is number 10. Home prices have begun falling in Sydney, in Australia, and Hong Kong, while values in Singapore barely rose last quarter. So as buyers are wary of rising interest rates and economic headwinds, they're moving to the sidelines. And we just saw that in the April housing data for Canada. So there's signs of housing slowdown everywhere in Canada, sales slowing, fewer multiple bidding situations, softer price gains in many markets, actual price declines in some, especially around the GTA, and new listings in some cases are picking up. Now, these higher interest rates will remove some buyers from the housing market and reduce the purchasing power of others. April's numbers of sales fell 12.6%. Now, those are national numbers, but the most aggressive declines occurred more in central Canada. Now, we're nearly at the end of the low rate holds. As we mentioned earlier, the pool of buyers with 90 to 120 day rate holds is nearly exhausted. They have mortgage approvals at rates up to 100 basis points below current levels, maybe even more than that. And they are highly motivated buyers. So that's going to add some activity over the near term. In addition, we saw the new listings on a national basis edge up slightly, very slightly in April, but we may well see a more considerable rise in new listings in the next month or two. We've also seen that the residential market balance is moving closer to being a buyer's market than it has been for a very long time. And we also saw that the home prices declined on average on a national basis. And that's the first time we've seen a considerable decline in average home prices in a very long time. So markets have turned very quickly. And as a result, some buyers have been caught offside in this turnaround, because when you have a seller's market for as many years as we have, there was every incentive for existing home buyers that were moving up or downsizing to buy before they sold, because they thought they could sell very quickly, and it was very difficult to buy with such limited record low inventories. But some who recently bought new homes are struggling to offload the old ones, which will be a buying opportunity for home buyers in the future. And that's why we'll see some housing inventory increases. And you can see that the price change in single family homes April to March is very aggressive in the hinterlands tech country in the greater Golden Horseshoe, Kitchener, Waterloo, London, Toronto, Barrie, and not so much in other parts of the country, but that could well begin to show through. And as I mentioned earlier, investors could move to the sidelines because now mortgage payments and property taxes are rising much faster than rents in many hot markets. And finally, we could see some distressed listings, especially for recent investors with short-term financing. And Metro Toronto is already a buyer's market, according to BMO research. So, it's there is for sure a massive shift in sentiment going on in the housing markets. And now on the supply side, the federal government has told us repeatedly that they're going to increase housing supply. They're going to double housing supply over the next 10 years. But I just want to reiterate that home building is not keeping up with new household formation. And that's shown here. That immigration levels will continue to be extremely high, and even higher than as a result of the easing of the short-term immigration policies in terms of allowing people to stay more than 2 or 3 years. And in addition, Canada still has the fifth strongest, seventh strongest population growth in the world, double that of the United States, and 5 times that of Germany, just as an example, or France for that matter. So, and also, there's been a lot of talk about foreign money pouring into Canada. We really haven't seen a whole lot of foreign money coming in on the residential side. But where we are seeing foreign money coming in is more in industrial space. Blackstone, a major U.S. company in the private equity space, has been buying real estate in Canada, mainly the warehouse sector. But they've opened an office in Toronto, and the new head of the Toronto office has recently said that Canada's population growth is the highest among G7 nations and is nearly double that of the US, and I believe will continue to create exciting opportunities in the market. Maybe that's a good lagging indicator, because ever since this was announced, housing in Toronto has certainly slowed. So the federal government's goal of doubling home construction over the next decade, I don't think so, or certainly not in the near term, because 2021 home building was already at a 46-year high in 2021. And since then, there has been more bottlenecking and supply constraints than ever before. Canada wants to double home construction, but needs to find the skilled workers. And the construction industry, every sector of it, is going on strike for higher wages. Lots of job vacancies in that sector. And I dug out the costs for residential construction costs. And the Stats Canada actually publishes those numbers on a quarterly basis. And you can see that the cost increases for residential construction are mind-boggling, just mind-boggling. So for Canada, just for the country on average, they're up more than 30%. And if you look around the whole country, the annual inflation numbers in 2022 thus far, Calgary's up 31.4%, 26% in Edmonton, Toronto 26.5%. The reason they're so high in the oil country is because wages are higher there. But you can see that, I mean, everywhere the cost of construction has gone up very dramatically. And why would anybody develop more construction if they can't recover it in the price of homes? So all levels of government agree we need more housing construction. The feds have introduced a $4 billion housing accelerator fund, but we all know that it's really, these decisions are made at the municipal level, and municipalities are trying to ramp up building permit issuance and reduce the delays between building permits and housing completions. But the incentives to speed up the approval processes will run headlong into zoning regulations and people not wanting to allow medium density development in low density areas. So I don't see a doubling in housing construction showing up anytime this year or next year. So that's it for me from the slides perspective. But I know, I mean, with all the uncertainty, we could debate this forever, but I'm happy to open this up to questions, comments.
Yeah, we have lots of them. I just want to make a comment because, that pause going on in housing can't last because there's so much demand. You talked about immigration, the economy is going well in terms of jobs. People are working. So it can't last very long. I think Canadians, this is a personal opinion, do this very well, where they pause, look at the landscape, and they make intelligent decisions. And I think if you are a purchaser or even refinancing, connecting with a mortgage broker is a good idea. Getting the right advice is really important, and making sure that whatever it is you want to do, either buy now, buy later, buy new construction, buy resale, move up or move down, there's always a strategy. So I highly recommend speaking to your DLC mortgage professional. You can do that by connecting them or with them on dominionlending.ca. So let's get to some questions. We have some more. Jason asked about, break the back. It's a global problem. How is Tiff Macklem going to control or try to do that here in Canada?
Well, it's not just Tiff Macklem that's doing this. The central banks everywhere are aggressively tightening monetary policy. No one pretends that the Bank of Canada can address the supply constraints or the war in Ukraine or the problems in terms of shortages of everything, basically. But what he can do, he can't deal so much with the supply side, but he can deal with the demand side. And if he can slow demand, and inevitably he can slow demand because this is a very interest-sensitive economy, then we could see lower inflation. And some of the transitory part of inflation has already begun to slow, but it's less transitory and more is sticky inflation that is of real concern. And once you embed inflation in higher wages, then you get this wage price spiraling. And when the costs confronting most businesses are going up, how can they stay in business if they don't pass some of it at least on to the consumer? And then how many consumers, particularly in the face of rising variable rate mortgage payments, how many consumers can still continue to buy at the pace we've seen since we've recovered from the pandemic? So, I mean, something's got to give. And for those who have had variable rate loans, even 50 basis point increases a month, that's a big chunk of change for most borrowers.
Yeah, and 4 to 5 banks, their rates change, their payment doesn't. So even though that's happening, which is great on a budget level, but you're paying less principal, you're paying more interest. So your equity and your net worth is decreasing as rates rise. So it's something, again, a conversation to have with your mortgage broker, what kind of rate you have. If it's adjustable or variable, there is a difference. There is rates that rise as the Bank of Canada changes rates, and there's some that the payment doesn't change, but your principal to interest does change. So let's talk about the next question, which is around labor shortages. How come wages haven't really gone up? Now they have gone up, but should they be going up faster? Do you predict that wages will go up even quicker because of inflation?
Yes, and they already are going up, where most rapidly in sectors where there are the tightest labor markets and the greatest job vacancies. And that's typically in lower income employment. But nevertheless, there's no question that even like all businesses need to keep their top talent, need to be able to attract top talent, retain top talent, and demand is for labor is considerable. So we do see a lot of movement, a lot of churning, a lot of, we call it the quit rate, people that are quitting a job before they even have another job. And and because they know that they'll do better if they change employers, because their employers are hiring new employees at higher rates than existing employees. And there's nothing that makes people want to change a job quicker than that. So it's very disruptive, but it is happening. And this is a major shift, because for years we saw profits going up faster than wages, and for years and years, and labor power diminishing dramatically. That's unionization has fallen, it's plummeted, and this could be the beginning of a major shift in that.
Makes sense. Okay, our next question comes from Devin. Thanks, Devin. Central banks want a soft landing, but oil prices continue to drive inflation. There doesn't seem to be a demand erosion. So what's going to balance the soft landing and oil price normalization?
Well, the one big answer is housing, because it's the most interest sensitive. Another, it would be the consumption of durable goods, automobiles, refrigerators, appliances, big ticket items will slow. And then eventually we'll see a slowdown as well in business investment. And with the stock market, we don't talk much about the stock market because it's like there's an infinite number of things we could talk about. But stock markets affect psychology, even for those who don't have big stock portfolios. When they hear that stock market is falling, people feel less wealthy. They feel nervous. Yep. And people are less wealthy. And most of us have some equity investments. If you own a home and you're old enough, and you're saving for retirement, and most of that is in the stock market. And not to mention pensions are invested in the stock market. So we've seen a big sell-off in stock markets this year for the first time in a very long time. And that's another negative. And one of the risks and tightening too fast would be a crash in the stock markets, which could lead in and of itself to a recession.
Right. Yeah. Okay, our next question is from Carlos. He says it's a hard question. I think I know the answer to this, but let's just say we magically made you the head of the Bank of Canada. Would you keep increasing rates?
I think that you have to keep increasing interest rates, because there's no other tool.
Yeah, of course.
Fiscal policy isn't tightening, right? They're not raising taxes, and they're not cutting government spending. So what other choice do they have?
Listen, the global economy works on debt, right? You look at governments, you look at big business companies, consumers. We all work on debt, and if rates are rising, you're going to think twice before you borrow. And like you said, they pass on to the consumer. So if it's businesses and you're paying more for those goods, and there's going to be some point of that break, and we're going to be spending less. Are we going to go into recession? We'll have to see, but we definitely are going to think more when buying goods, knowing the price points, or for borrowing. So that all makes sense. Okay, so are we headed for a recession?
Could be not this year, but next year. And I hope we aren't, but I don't see, let's put it this way, the unemployment rate has to rise in order to fill all these job vacancies. People have to stop thinking that they can get another job really fast. And that's an important component. And I don't know how you get the unemployment rate to rise much without triggering a recession. But we're going to see. I mean, this is a real life experiment here. And we've never seen anything like this before, because at the same time that the central banks drove interest rates down like crazy to practically zero, they also bought lots of longer term government bonds. And now central banks everywhere are selling them, which drives the price down, which means interest rates up. And so seems to me that this is a recession waiting to happen. But hopefully it's a mild one and a short one. But, central banks, this is a blunt instrument. They can't fine tune this very easily. And remember, we all watch the economy with a rear view mirror because we get the data with a lag. So we only know what happens in the past, not in the current period. And the big thing is not in the future. So, but it makes housing more available for home buyers if there are more unsold homes out there.
Yeah, for sure. But just to be sure, the definition of a recession is 2 quarters of negative GDP growth.
Right.
Okay. And things happen so quickly going down, can happen just as quickly going up, and we can just miss a recession, meaning 2 quarters. That's 6 months of negative. We could miss that and come back. So, you never know. Okay, let's go to the next question. Any idea of the market from Durham region Kawartha, same as Toronto figures?
Oh, I don't have those numbers in my head. Sorry. But if you look on my website, sherrycooper.com, you'll see the April CREA table, and it gives you exactly what the April numbers were. And we'll get the May numbers June 15th, and I will write about them.
So you talked about labor shortages. You talked about people going on strike in building homes. Is that going to affect resale? I mean, of course it is, because it's a down effect. So if you're paying more for a new home, then obviously, homes existing are going to go up in price. Would you agree to that?
Well, normally it's just, and it's somebody who's already bought and hasn't sold yet are going to get very nervous about having 2 mortgage payments to make. And so there could be some real deals out there.
There could be. Yeah, it's those first-time home buyers sort of, got punched a little bit again. They saw the prices come down, but now their qualifying rate goes up. So is that, cost of borrowing still there? So, but hopefully it'll all weigh out to get more first-time home buyers in the market. Okay, a couple more questions and we'll end this, Sherry. Again, we apologize for being late. There's technical difficulties, but we want to thank FCT again for sponsoring today. They're great partners. We love them, and they do great things for our industry. Okay, so on your immigration side, it listed economic, and these are good skilled laborers, right? Yes.
Yeah. Yeah, that's why Canada without immigration would have a negative population growth, because our birth rate is lower than our death rate as the population ages. So, I mean, it's a good thing that we have immigration, and we need immigration. But these people have to live somewhere. But they can fill jobs, and they are filling jobs that others aren't willing to take. And also, many of our immigrants are very highly skilled and well educated too. So it's not just the lower wage jobs that they're filling.
Absolutely. Okay, our last question from Naz, and we're going to have to wrap up. Can we say the increase in rates will just leave us with real demands instead of stressed demands?
I think that makes some sense. Yes. And people aren't going to be flipping because it's going to be much more difficult to do that. And that's what I'm saying. The speculators, I think this takes a lot of the speculators out of the market.
You know, I have to agree with Jason. This is one of your best, Sherry, and you are always so informative. You take it down to the level where you can understand. We really appreciate, everything you do for DLC. Being our chief economist, we couldn't be prouder. Thank you, thank you, thank you. Just so you all know that our next session will be July 13th. That's when the Bank of Canada will raise rates, maybe 50, maybe 75. We'll have to see. But again, you can tune in and listen to Dr. Sherry Cooper's opinions, her advice. She's always on the ball. We really appreciate that. Thank you, FCT, for your sponsorship today. Thanks, everyone, for joining us. Until next time, take care. Bye-bye.